Hello everyone, and thanks for joining me. So the presentation today is focused on the use of options to not only leverage your potential returns on gold and silver, but also how to use the option to actually hedge or protect yourself during the volatile downturns that we experience in gold. So it's not only about this really great returns on the upside, but also the risks and how to manage those risks. So I want to focus on the cyclicality of gold and silver. Grant Williams was up here earlier, and many other speakers talking about the breakout of the next big gold bull market. And we have this beautiful bull market starting where potentially the last time we saw a basing of 6 years like this was back in 1998 to 2002, 2003, which saw a fourfold increase in gold after such a 5-6 year consolidation. I'm not using that as a base of a forecast, but rather to give context that when a bull and bear market cycle begins, they often have these enormous opportunities to go through there. And so looking even here at the silver market, you can identify this long basing formation that we have seen over this period. Now, when one of these gold bull markets begin, it's not a straight line up. In fact, let's say we go back to 2001 to 2005, there were at least 6 occasions where there was a 10 to 20% market pullback that lasted almost 2 months in duration. So there's these periods where it shoots higher and then pulls back and shoots higher and pulls back. And I wanted to go on an adventure and figure out how to measure these cycles and what do these cycles look like and how do you trade them. And you can see here even in the 2008 to 2011 period, you can see there was at least 4 periods where this type of a pullback occurred. And so I wanted to ask a simple question. And I said, well, taking gold miners, right? Because gold miners are this leveraged way to play gold and silver. And I said, well, let's just do two criteria. And we want to only measure cycles that were at least 20% in magnitude, higher or lower in a move. And to avoid liquidity events, I wanted the trend to be in place for a minimum of at least 2 months. Right, and so what we determined is that when I measure this out, going back to 2006 when the GDX started to trade, there were 8 of these cycles, trough to peak and peak to trough. But what's amazing is actually what was the average duration and the magnitude of those moves. What's surprising is based upon that criteria, most of these, the average cycle lasted less than a year. In fact, close to 10 months. And look at the magnitude of the rises over a 9 to 10 month period. Near 90% rises. But when you're on the wrong side of one of those cycles, a 40 to 45% average decline. In this sequence, you can see at least 2 occasions where the rise were greater than 100%, including that one run that was 250% on the upside of the GDX. But at the same time, there were 3 occasions where the gold miners wiped out over 50% of their value. Right? You need ulcer medication to ride out being a long-term buy and hold investor in gold. Right? Now, with that said, how were the last 2 cycles? How did they play out? And what you can identify here is that the last decline, which was September 2017 to September 2018 based on that criteria, was about a 12-month decline from peak to trough of about 32%. And the last rise, which started about September and peaked in the last peak was in September of just 2 months ago, was a 79% rise in 12 months. And so you can see that a little bit longer, the last 2 cycles than the average, and a little more shallow than the last 2. Now, if we have not officially turned the last cycle. In fact, arguably, if the GDX broke out and continued higher, then we don't actually have a marked peak yet because we haven't seen a 20% decline to actually begin the count. But the point I want to make is that there's these pronounced cycles within gold and silver, and I want to spend some time talking all about how to trade these using options as a strategic tool. And I want to focus particularly on call options. And call options are a contract that give you the right to buy the stock, not now, but in the future, at a fixed price over that fixed period of time. And almost on GDX, those options are American style, which basically means you have the right to call in your stock position anytime you want and take on physical ownership. This is why the option has value, because you have the ability to call in and buy the underlying security. Now, I want to focus on one particular type of option, and that's the longer dated options that have 1 to 2 years of time. Why? Why not choose these 30-day and 90-day kind of speculative options? Well, we just measured out the cycles. The average cycle in one of these gold moves, higher and lower, has been more or less 9 and 10 months. So if we look at those options with 1 and 2 years of time frame, we know we're going to capture within there an average cycle rise and or an average cycle decline. And so I don't want to worry about this buy low, sell high, short-term trading, but rather have an option that you can hold through the entire cycle. The second variable and advantage of longer-term options is the rate of time decay is slower. Most people, when they learn about options, assume that it's a linear time decay, which is that it's arithmetic. 60 days, you divide it by 60 days, and every day it decays by that amount. But options actually are exponential in their nature, which is that the time decay in an option starts incredibly slow for long-dated options and accelerates to the fastest rate of time decay occurs in the last 45 days. And so when we buy these longer dated options, we're not dealing with options that have this short-term time decay. So I want to introduce you to two option Greeks. Now, I don't in 20 minutes have the ability to take you through an options training course and get you understanding deltas and gammas fully, but I do want to capture, and I want to bring it up for one particular reason. Delta is the rate of which an option behaves like the stock. To give you a very simple example, is an option that has a delta of 75 cents means that if the GDX rose $1, the option on GDX would increase by 75 cents. So it's telling you the rate of which the option is behaving like the underlying stock. The gamma is telling us the rate of change of that delta. And so if I was to just give you a very quick chart, a stock has a 45-cent delta, a 45-degree angle, delta 1, which is essentially if the stock was to rise $1, you make $1. If it goes down $1, you lose $1. The stock has a very simple linear relationship in terms of profiting. Now, if something has a delta 0, it means it's price insensitive. The option is price insensitive to changes in the security's price. So an option is the journey between delta 0 and delta 1. This is why options have this hockey stick curve to them when you look at the risk graphs that you would typically see on an option. And what I want to just simply highlight is that when you own an option, it's the journey of it along the slope of this, which is that an option goes from potentially having a delta near 0 to a journey of it being trading very close to delta 1. Now, that seems like a lot of complicated stuff, but really there's one simple thing I need all of you to take away from this. It's this. When a stock is declining, you're losing at a slower and slower pace the more and more you become wrong. And when you are right, the more the option is behaving like the stock, and it continuously is increasing more and more till it behaves like the stock itself. And so there's a natural asymmetry in this option in the fact that we can play out these cycles and take advantage of this relationship. Now, it's too good to be true if this, it would be too good to be true if this came for free. The thing is that this comes at a cost. And the cost is the premium. And that is your negative carry in your option. And so there is a general mispricing in long-term options is what I believe. And I want to focus on why I believe this is the case. So I want to go back to an example I gave back in 2018. I want to just explain how someone determines, like how do you determine an option is worth $1 or $2 or $3? It's based upon the implied volatility that is being priced into an option. And the implied volatility is measuring what the expected range of the stock is to 1 standard deviation or 2 standard deviations. Now, there are skews in the options market, but this is a general capture of how the probability distribution occurs in option pricing. So in this example, when I was here at the Silver and Gold Summit last year, I gave this example. I felt it was really important to bring it back and actually illustrate what ended up happening. And so back last year when I was doing this presentation, we were looking at the January 2020 option that had 492 days until its expiration at the time. And it was being priced at a 27.7% implied volatility. That would suggest that at the time, that would be a 1 standard deviation move would be about $5 in the course of about a year, more or less. And that would mean that to a 68% probability, that option was pricing in the GDX would trade within $13 to $23. That's the way that option was priced. So though we just showed you in the last 8 cycles on the GDX, the average 9-month swing in the GDX was an average gain of near 90% and an average loss near 45. So when you actually compare number 1, which was the standard deviation priced into the option, versus that 2 of what the actual average historical swing in the GDX is, what you can see is that the GDX has been far more volatile. Now, the implied volatility changes on the option all the time, but at least this example, we can now actually compare what they were pricing and what actually happened. And so an update now, when we looked at what happened in the most recent cycle during the 79% rise that occurred in the last year, since we actually demonstrated that option last time, what you can observe is that call option went on to rise from $2.55 to trading near $12.50 at its peak. Now, every speculator in the room is thinking, oh, you know, like a 400% or 500% return, that's amazing. And that's in itself okay. If you're a speculator and you were looking at using the option to juice up your returns, well, for certain, that is the type of return you would have experienced in owning the option. But that's actually not what excites me about options. It's about the way we can manage our risk while we're in the trade. And I want to really focus on this. And so I'm going to use an example of 3 investors. Now, many of you in the audience are stock-only investors and are saying, Patrick, you know, you're talking about all these options. That's not my thing. I'm just going to buy the GDX shares, and I'm just going to be long gold. That's fine. That's our stock investor A. Let's compare how they did versus our other investors. Investor B is a conservative options investor. That investor is using the option as an alternative to owning the shares, but not seeking any further leverage than they would have if they bought the shares outright. They're simply using the option as the vehicle from which they took the position. And investor C is our speculator, the one that says, I want to juice up my returns a little bit. I want to actually leverage and get more exposure than I would. The really good advantage of investor C is that often most investors cannot leverage in their registered retirement accounts and so on, but you can buy options in them. And so often people can use these options as a way to gain exposure in different account forms. And so now in our scenario, all 3 of our investors had $20,000 to work with. And in this scenario, they had the choice of buying the shares and or buying that call option we talked about, which was trading at $2.50. So investor A buys 1,000 shares. This is a story that all of you would know. You have $20,000, you buy 1,000 shares of the GDX, it was trading at $18.15, and you're buying $18,150 of stock, and subsequently have a balance of $1,850 sitting in cash. Now, investor B wants to control the same 1,000 shares that investor A does. No leverage whatsoever. They have the same $20,000, but is simply choosing to buy 10 call options, which are securing the right to buy this underlying stock at $18 over the next year and a half. At least this was the example when GDX was trading at 18. Now that means the investor outlaid $2,500 for the investment and has $17,450 sitting in a money market fund safe in cash that cannot be lost. At the same time, investor C says, I want to have an additional 50% exposure. You can multiply that number to 100% or whatever you're looking for. But in this scenario, the investor wants to control 1,500 shares, so they buy 15 of these call options for $3,825, and as well are left with $16,175 that they subsequently put into a money market fund in cash. So now, let's, for the sake of the example, assume the GDX only did an average move, either higher or lower. Because I want to demonstrate to you what would happen, not only if they were right, but what happens if they were wrong. And that they, in fact, got caught in the cycle and, in fact, were wrong. And so in the scenario 1, you can see investor A owned the physical shares, and they had a Delta 1 experience, which is every dollar GDX went up, they made $1,000. And in the end, if the GDX rose that 90% over 9 months to $35, they'd find that they made $16,150 on the way up. Investor B starts a little slow out of the gate because they're fighting some time decay and some negative carry. The first move to $20 is not a big move. But what you can see is that as GDX is rallying, as it goes from 25 to 30, 30 to 35, the investor who owns the call option is almost participating dollar for dollar the same as the investor A. And in the end, has not gotten much different of an experience when being right. Now, investor C leveraged up. And of course, you're going to be rewarded for being right when you leverage. So you can see investor C ends up being up nearly $22,000 in that same move. And again, the same experience that the more that they become right, the more the underlying options start behaving like the underlying stock. But I want to talk about the second scenario. And the second scenario is, well, what would happen if the GDX did nothing for the next 9 months and was trading at the exact same price it was trading when you bought it? Well, this is where you have the negative carry. Those options would be experiencing time decay, and you would find that they are losing some of their value, and there's a carry cost to owning them. But I want to go to scenario number 3, which is your timing was awful, and you caught one of these down cycles in the GDX, and it proceeds to lose 40% of its value in that subsequent 9 months. That investor that bought those GDX shares early experienced a loss of 40%, down almost $8,000 on their shares, and is questioning whether or not they should be invested in gold and all the other things that goes through an investor's mind when they're down 40%. Now, notice that investor B started losing a little faster because they were experiencing time decay on the option. But notice as they became more and more wrong, they were losing at a slower and slower pace to the point that the risk was maxed out at the value that they paid for the options. And so they never actually experienced an $8,000 loss on the way down. Yet when you saw in the earlier example, they made almost all of the money when they were right on the way up. This is the asymmetry in being able to use an option as a strategic tool to trade these different cycles. Now, investor C made a pile of money leveraging up for when they were right about the gold run. You would assume that they took on all this extraordinary risk that would have been far greater than owning the shares. But notice here, investor C still actually lost less money than investor B is down. Now you'll tell me investor A. And by investor A, you'll say, oh, but investor A could buy and hold and eventually it'll come back. Of course that might be the case, but at this moment when GDX is down, investors B and C are both far better off in their account than investor A. But this is not the best part. The best part, investor A has used up all of their cash. And so if they wanted to dollar cost average because they believe it's going to start going back up, they have to go and find new money to go out and buy and deposit in the account to dollar cost average their position and buy more shares and reduce their price. But investor B and C had all of that cash sitting in a money market fund. They only allocated a small portion of their capital to buying those calls and had all of that cash sitting in reserve. So now what can investors B and C do that investor A couldn't. Now take advantage of the fact that GDX was trading at 10. So what happens, investor B and C, now let's say they were wrong, they lost money on the way down, but GDX now trading at $10, they can now reposition and take advantage of the GDX down at the new $10 price and buy new call options to participate on the next cycle higher. So you had the tactical ability to be wrong, reposition, and still be able to come out ahead at the end of it all. And that tactical ability to reposition yourself using options is something a buy and hold investor simply doesn't have the ability to do. So notice here in this example, a $10 GDX, let's say if it was down there, that investor who had $17,000 sitting in cash was able to now buy 17 new call options to control $17,000 of new stock. Even though they lost with 10 call options on the way down, now they have 17 call options on the way up, not being leveraged at all. Right? Investor C is able to now control 24 call options at $10 a share. And so it's not about the fact that options are amazing on the way up. They are, but they also give you the ability to reposition yourself when you're early and wrong on a trade. You can position yourself again to take advantage of the next cycle turn higher. And that is the ability you have with options for managing these cycles. So this is what we do, and this is how we do it. At Big Picture Trading, we take these macro insights, we take the market timing of the technicals, and then we use the asymmetry we can build with options to put them together to come up with these strategic trades. We're trading these cycles, we're identifying them for our members, and what I welcome all of you to do is if anyone wants to visit us at bigpicturetrading.com, you can see me calling these cycles and the option strategies we're using. Welcome all of you. It's a free access with no strings attached. You can come and try the Big Picture Trading membership, see how I'm positioning myself in gold right now. You can do it through the website or visit us at the booth by the entrance. Thank you very much, everyone.